Hi, everyone. I'm Hans Mata from EquityMultiple's Investor Relations team. Welcome to this discussion about a recently published article and infographic, A Guide to Alternative Investments. Joining me today is the author of this piece, Charles De Andrade. Charles, thanks for being here. Before we delve into our discussion, I'd love for our investors to get to know you a little bit better. You're a relatively new addition to the EquityMultiple team. I believe you're just about 6 months in now, but you're bringing with you about a decade of experience in real estate investment banking, including being a member of the Chartered Alternative Investment Analysts Association. Could you briefly explain to us and our investors what it means to be a CAIA charter holder?
Yeah, absolutely. And thanks for having me, Hans. Pleasure to be here today with you, as well as virtually our investors, and having co-authored the piece here on the investment guide. Happy to shed more light on that, as well as being a CAIA charter holder. So actually one of the focus points of CAIA is the focus on alternative investments and sort of all the theory and the knowledge that sits behind that. It's an organization akin to the Chartered Financial Analyst Organization, or CFA, which undoubtedly some people will be familiar with, albeit the CAIA Association focuses exclusively on alternative investments. So that's private equity, it's hedge funds, it's venture capital. It's also real assets, obviously including real estate here at EM, but also branching out to sort of more novel alternative assets such as investment, intellectual property, art, movies, patents, and other categories. So yeah.
Can you give a brief explanation of why we're publishing this piece now and why this might be an important moment to take the time to evaluate your portfolio and potentially consider adding alternatives?
Absolutely. I think, as evident by the current market, unfortunately, but in a high rising interest rate environment, record high inflation, volatility has picked up significantly across investments. And so you're seeing a lot of that movement of trepidation in the market. And then add to that your sort of geopolitical concerns with a lingering pandemic, as well as European war in Ukraine. And so there's a lot of turmoil and a lot of uncertainty in current markets. I feel that looking back historically, whereas alternative investments may not have always been accessible to investors, I feel like platforms such as ours, democratizing sort of the access to this line of products or investment vehicles, it's an opportune time to sort of read through the array of options that are out there in the market, and it felt like a good positioning tool to basically recap to our investors. This is the spectrum as we see it, and then obviously our offerings are included in that to help sort of position in from a risk return perspective, and more so risk adjusted return rather than just simply risk return, as well as basically offer comparison across the broader spectrum of investments in general.
Yeah, and as a member of the investor relations team, we're getting a ton of questions these days where people are kind of confused about what to do with their investment portfolios next. So let's take a minute to break down how this table is structured and dive in a little bit deeper.
Yeah, no, and that makes a lot of sense, especially in this environment. And so we've structured a table with sort of your readily available savings products, such as certificates of deposits, as well as I bonds, and going to sort of corporate bonds, sort of lower risk savings like products, if you will, and then going sort of into the sort of light green towards orange segment of the investment guide. Here are the products that are centered around either stock or portfolio or alternative investments. And so for those products, we have taken the approach of ranking them or listing them according to volatility. And so ultimately, sort of risk-adjusted return type look at those range of products, really trying to encapsulate the broad spectrum of investments that are currently available. Understand that there are ultimately more investments or categories available, but we just wanted to highlight the more important ones or the more prominent ones, and then also infuse some of the EM product offerings to give investors a sense of where do our products sit relative to sort of a broader spectrum. I think important to note in our spectrum is that for a lot of these investments, we've looked at benchmarks or blended return metrics over the past 10 years. And so as a result, the risk associated with these products is going to show differently than a singular investment in, for instance, venture capital or hedge funds that would typically far exceed the risk appetite of our investors, I would imagine. And so as such, that's important to note that the investments here are shown on a blended basis. So definitely happy to get into more detail on that.
It might be helpful first to frame the discussion from the standpoint of a traditional portfolio. Often investors, will call in and they'll have what are called 60-40 portfolios, or a combination of 60% stocks and 40% bonds, or a similar variation. Could you speak to the rationale behind this portfolio?
Yeah, absolutely. That's your traditional portfolio in a way where it's historically been structured that way, where the bond element, typically this 40% component, provides income generation due to yield, and then also offsets some of the volatility associated with the 60% stock component, which is more capital appreciation focused. And so you'll see that 60-40 split sort of migrate over time or dependent on investors' personal preferences. Obviously, the closer, for instance, you get to retirement, the less risk one is typically willing to take or should take to be prudent. And so as such, you'll see that 60-40 sort of shift. But what's traditionally referred to as a 60-40 portfolio is a portfolio consisting almost exclusively out of stocks as well as bonds. I think key to understand here in this sentiment is that both stocks and bonds, whereas traditionally there is some offsetting or diversification benefit to them, in times of high inflation, high volatility, the correlation between stocks and bonds actually increases. And so that's one of the key factors that's really the demise of the 60 portfolio as we see it today, is that some of those diversification benefits no longer hold to that extent. And so you're seeing a lot of the sort of movement associated with these basically due to a lack of diversification or investment in non-correlated assets.
So of course we're here to talk about allocating into alternative investments, but could you briefly speak to the performance of the traditional 60-40 portfolio recently?
Sure, Hans. So, as many of our investors will know, this has undoubtedly been a bad year for stocks in general, but especially also for the 60-40 portfolio. The S&P is down about 17% in the first half of the year, although it's had a much better month of July, fortunately, for a lot of investors. But the first half performance has lagged significantly. So this currently would be on track for sort of the worst performance in the top four historically, trailing only behind the Great Depression as well as the early 70s bear market. So this is quite bad. So that carries over to the broader portfolio. If you factor in the bond performance as well, so if you proxy that by the Bloomberg Barclays U.S. Aggregate Bond Index, which is part of our investment guide in the bond offering product. And so if you proxy that, it's actually on track for the worst performing year ever in terms of bonds. So pairing those two together in a 60-40 portfolio setting obviously makes for quite a bad year of performance, and a stronger case to include alternatives as a means of diversifying away from that 60-40 exposure, as well as that increased correlation that I spoke about between both bonds and stocks. And so that's really where the case comes in to look and expand into some of these other investment products.
And we're at a really exciting time where investors actually have the ability to, incorporate more alternatives into their portfolio. However, of course, with it being such a new space, how would you recommend, beginning investors start to allocate to alternatives within their broader portfolio?
I think that's a great question. I think before we get into the answer on that, I think it's key to highlight some of the characteristics of alternatives in general, and then I can get into more detail as to how the diversification really comes into play. There's a key characteristic of alternatives. These are often investments that are private in nature, and so offer a lower or non-correlated nature to the stock market. And so that really offsets some of that correlation that I spoke about. And really, when you talk about portfolio diversification, whereas the 60-40 portfolio almost focuses more on diversification through sheer numbers, so basically risk dispersion, adding multiple companies, sort of everyone can attest to. It's more beneficial to own stock in 100 different companies, disperse risk that way, as opposed to picking just two companies and running with it. It's a 50-50 call at that point. And so that risk dispersion nature of the 60-40 diversification really gets improved by diversifying with alternatives, as you're looking to add some of these lower correlated investment products that may even, to some extent, offset some of the motions you see in the market. And so that brings us to really a second component of alternatives, where some of these alternative investments can be offsetting to higher inflation, can be offsetting to higher interest rates, and sort of other macro shocks. For instance, commodities are a great investment in times of high inflation, as they actually make up a large part of inflation. Real estate, in particular, can offer a good inflation hedge, as well as an interest rate hedge as well, due to the ability to capture part of the inflation through shorter term leases, or offset in terms of private debt specific investments, offset a higher interest rate environment through floating rate debt investments. And so that's really, in a nutshell, the value add of these alternatives in a traditional portfolio. And so getting away from that risk diversification through just pure dispersion is beneficial, as well as just lowering the correlation across investment assets as a whole. And then a further important point to note on alternative investments is that the correlation amongst the alternative investments in and amongst themselves is fairly low as well. And so that further adds to the beneficial element in terms of adding not just real estate and part of the real assets, but also private equity or private debt or hedge funds or venture capital investments to a portfolio can be beneficial from a risk diversification and dispersion perspective.
So how do our investors, now armed with this knowledge, turn it into actionable investment decisions?
Yeah, I think that question makes a lot of sense. I think before we get into what portfolio would look like in today's environment, I think it may be helpful to give a bit of a backstory on the history and how we've gotten to this environment today. So the allocation away from that sort of traditional 60-40 portfolio that we spoke about really started with the endowment model as pioneered by the late David Swenson at Yale University, where as an endowment, sort of the nature is more multi-generational, sort of indefinite lifespan, and typically sort of spending around 4.5% per year. And so that allows to look at investments from a sort of different perspective where you're looking on the sort of absolute long term compared to someone's individual investments. And so that really allowed David Swenson to aggressively allocate towards alternatives and seek those out and infuse them in portfolios. So this has been around since early 80s. So this is quite a long-standing theory. It's not a sort of recent trend of allocating to alternatives. Now that said, in the sort of non-institutional world, so looking at high net worth investors and individual investors, this is obviously a new development because of the fact of sheer accessibility, right? 10, 15, 20 years ago, you didn't have platforms such as EquityMultiple and some of our competitors offering investment in a wide array of these alternatives, so not just limited to real estate as per our offerings, but also in art and collectibles and sort of all these other investable products that are coming to market, right? And so that really has opened up that market and that accessibility to gravitate towards investments in this alternative sphere. And so where you're looking at some of the institutionals allocating, again, those endowments, those pension funds, those insurance funds allocating 20, 30, 40, sometimes even 50, 60% of their portfolio, it's sort of quite significantly picked up and improved and sort of developed over time. Now, for our individual investors, I should preface this and say that we recommend our investors have the conversation with their investment advisors in their investment policy statements to figure out exactly what their risk-adjusted preference and tolerance can be and what products are really suitable for them. And so there is no sort of golden number or ratio for someone to strive for in a portfolio. It's going to be highly dependent on one's individual situation, one's individual risk tolerance. But that said, the research and sort of current numbers point towards the suggestion of a potential 50-30-20 or 40-30-30 portfolio. This is at the institutional level. So these are some of the institutional investors that are taking this approach and basically putting 20 to 30% of their investment allocations towards alternatives. And also important to note here that alternatives don't exclusively include or consist of real estate. This spans the sort of full gamut of alternatives, right? So this is, as per our investment guide, this includes investments in private equity, in hedge funds, in venture capital, and then in real assets, of which real estate is obviously a component alongside commodities and art and other intellectual property investments.
And Charles, I know in the guide you compared a traditional portfolio to a portfolio with an allocation to alternatives. Could you
Right.
speak to how they differed?
Yeah, absolutely. So we felt it was important to not just show the individual categories of investments in the guide, but also show what it does from a portfolio basis. So we're fortunate to have access to some of that data to the CAIA Association, where for the 10 years ending in December 2020, so capturing actually a portion of the COVID pandemic, we looked at the numbers both from a traditional 60-40 portfolio as well as a sort of pro forma alternatives portfolio, if you will. And so that 60-40 portfolio versus that alternatives portfolio, that illustration is really to hammer home the point of a superior risk-adjusted returns, because that 60-40 portfolio over that time frame would have come in at about a 6.7% return versus a 9% volatility. And so that's a traditional 60-40 portfolio. Comparing that to the alternatives portfolio, which is in this case actually aggressively allocated to alternatives, consisting of about 60% alternatives and then the remaining 40% in that traditional portfolio. Over that same time frame, that portfolio would have yielded an 8% annualized return versus a 6.9% volatility. So again, that's compared to a 6.7 return and 9% volatility for the traditional portfolio, which illustrates really perfectly that superior risk-adjusted return basis where allocating that much incrementally to alternatives, which we wouldn't necessarily recommend to our investors without a consultation with your investment professional or an assessment of your own risk tolerance, really shows how aggressively allocating to those alternatives can shift that dynamic or that narrative around those risk-adjusted returns, and over the 10 years ending in 2020 would have actually delivered to you a better return at a lower volatility. And so I think that's probably the single most sort of key element to show the power of adding alternatives to a portfolio. That said, historicals obviously don't hold for future. So especially in these uncertain times where there's these many different factors adding to stock and portfolio performance, it remains to be seen how that plays out over the next 5 to 10 years. But that said, it definitely underpins the rationale of the superior risk-adjusted return associated with alternatives.
That's impressive. Especially, when one thing we kind of preach across the investment industry, it seems, is that, risk is going to be generally correlated to return. So whenever you're able to find, a situation where you're still getting, a higher return with the lower risk, and you're not seeing that standard correlation, I think that's obviously something for investors to take note on, and help them consider getting their feet wet into into this new type of investment.
Absolutely.
So one question I get a lot of, just in my conversations with investors, is we'll find that a lot of people are allocated to what are called REITs, or real estate investment trusts, that are traded on the stock market. Could you speak to a little bit about how they are distinct from private commercial real estate investments or alternative investments generally, and what your general thoughts are on those?
Yeah, I think REITs are an interesting offering. They were actually originally seen as the original method of adding alternatives to a portfolio. As you mentioned, access to real estate, divisible access to real estate, actually, I should say, as opposed to singular large ticket real estate investments, is one of the key factors of REITs. And so it has done a lot in terms of making investing in real estate a lot more accessible to investors. But that said, it's a publicly traded vehicle. And so as such, there's still a fairly strong correlation with the stock market. And I think that's particularly evident if you look at some of the discounts at which REITs are trading to net asset value, or NAV. As of late May, as per the S&P, the sort of average REIT was trading at about 15% discount to that net asset value. So that's sort of the publicly listed REIT value as opposed to, or compared to, the intrinsic net asset value at the private real estate holding level. So that's a significant discount. So it's great if you're buying in. If you're holding that, you're holding essentially an investment in a product that's not valued at that sort of fair level value, right? And so that's one of the complexities with REITs. And so I would say, combining those two, so both the correlation with the stock markets as well as that potential to trade at that discount to NAV, because of late, some of those REITs are actually even trading at 40, 50% discount to NAV. And so that's a substantial dislocation to value, which on the private real estate value, there can certainly be dislocations as well, but at least you're not sort of trading in a publicly available stock price and having some of that correlation to the stock market. And so that's one of the benefits of investing in private real estate.
So just as a reminder to everyone listening, the guide to alternative investments is available in our resources section for you to explore further. Charles, thanks again for joining us. And before you go, do you have any thoughts to leave our investors with?
Thank you, Hans. It's been a great pleasure to take the time with you today and virtually with our investors. I think, just summarizing our conversation here, it's generally still challenging for investors to access the full range of alternative investments. So we felt that this guide should be a useful framework in terms of helping position the choices between some of these products across the spectrum. And obviously, platforms such as ours help facilitate some of these access to these strategies through not just offerings that we put on the website, but also really reinforcing the process to providing oversight, due diligence, and ongoing management of some of these direct investments, which can be sort of the next layer of challenges to investors, right? Having the adequate sort of process around making that actual investment. And so that's definitely one of the features that we look to offer at EquityMultiple. I think taking a step back and looking at more broader perspective, I think we obviously support diversification. And so while diversification holds at that 60-40 portfolio in terms of risk dispersion, as we spoke about. There's definitely empirical support for adding alternatives and not just diversifying purely based on numbers, but also adding low or non-correlated products to your portfolio, which sort of bring down the overall correlation, and also ways of increasing your superior risk-adjusted return through investing in lower volatility products that yield a better return. And so that's definitely part of accessing alternatives. I think we further believe that the pivot or the interesting alternative shouldn't be of a short-term nature. This should be something that our investors should discuss with their investment consultants or professionals in their investment policy statements. For self-directed portfolios, they should look at their own risk tolerances and really look at it from a long-term perspective. You're not looking at this from a perspective of bypassing the current market turmoil for the next 3 to 6 months. You're looking at this on a multi-year basis as part of your overall investment strategy, really long-term. And so I think that's important to note. And I think a really good final point to leave our investors with today is that we obviously support diversifying on our platform as well. So not just, again, the risk dispersion, sort of numerical aspect in your traditional portfolio, or just adding alternatives to add superior risk-adjusted returns. But once investors are on our platform, we would highly encourage them to diversify across sectors, across strategies as well, just really to capture the benefit of adding these lower volatility, lower correlated returns across your portfolio. And as part of that sort of really long-term view on adding alternatives as a whole as an investment strategy to your portfolio. And so hopefully this will add a benefit to our investors. And again, thank you so much for taking the time and virtually joining us today.
And for everyone listening, if you have any follow-up questions, please feel free to give us a call at 646-844-9918, and we look forward to speaking. Thanks so much.
Thank you.